Welcome to a video that I like to call the deep dive video. As I explain every week, please don't let this name mislead you. I do a number of videos each week. I do a daily video, I do a weekly video, I do an intermarket analysis video. And at the end of that week, I go through all of the daily charts and I pick out those charts that maybe aren't really screaming anything real loud right now. And I didn't show those in the video. And I take those charts as well as some other charts and put them together in this video, because sometimes we can get some additional insight that we may not get otherwise. This is being prepared for Monday, November 6th. The first chart that you see is the VIX. Unfortunately, the VIX is invisible on this chart, but fortunately, there's a 50-period exponential moving average. That's the blue line that we see here. Now, typically with the VIX, you use static numbers. 12 and below, that means that the market is very complacent. 20 and above, that means that there's excessive fear in the market. Well, you can see by this blue line that we don't always stay within that range. We might go through a period of a number of years where we actually change the range of the VIX, where we go up to a higher range, then down to a lower range, then back up to a higher range. Over on the right-hand side, it looks like we might be going through the process of creating a lower range. At least we're lower than what we typically have been. We'll have to see if this develops into anything. This isn't something that we really base decisions on. This is more informational, and that's why I show it in this video. Then we have another way of looking at the VIX, and this is an S&P to VIX correlation. Sometimes we get insight looking at the VIX. Right now, it's been pretty insightful. But there are times when it's not really acting in a way that we can analyze things. So sometimes we get some information from this chart. This is the correlation between the VIX and the S&P. And when this really goes up and starts to spike above this dashed line, that means that sometimes it means that we're at a top or a bottom of some kind, and the market is anticipating some kind of a move. And then when we drop back down, the market ends up moving. Well, we're pretty much in the middle right now and not getting an extreme reading, so I haven't been using this chart. Then we look at how fast is the VIX moving. We use an RSI based on 9 periods to show speed of movement. And we're starting to really come down with the VIX because we had a really solid up week. Not so long ago, I was actually using this chart in the daily videos because when we were going down pretty fast. And so we had an extreme positive reading. Remember, the VIX is inverse to stock movement. But now we're going down here and we're not extreme negative yet. But if we see more strength in the market, we might end up getting an extreme reading. Then we look at another way to analyze fear in the market, and this is called the skew index. The VIX index uses at the money options. The skew index looks at out of the money options, and sometimes we can get some insight for that. When this really starts to spike up and come back down, sometimes that marked the top, sometimes it marked the bottom, sometimes the market didn't really pay attention and just kept going in the same direction. Right now, we're just about in the middle, so we're not really getting anything from this chart. Then we look at the MOVE index, which measures the volatility of bonds. That's on top. The VIX measures the volatility of stocks. And then I have the spread down here, which is the green area. And we were going sideways quite a bit, but now we're starting to go back up as stocks have been going up. And so that's just suggesting that there's more movement in the market. What I look at the most is on the bottom. I want to see how is fear in the bond market comparing with fear in the stock market. And right now they have a pretty strong correlated relationship. As this bottom line keeps going up, that means they're going in the same direction at the same time. Then it's kind of nice to know, where are we if we want to go back and look at the all-time high. We're down 9.55%. That's over on the left-hand side. That was set in early January 2022. Over on the right-hand side, this is where we closed in Friday's session. Then we do a number of advanced decline line studies. The one that we really focus on is the S&P. But to get a broader measure of things, we look at the NYSE, and there's a number of different studies that we use there. This one just looks at common stock. The top area is based on price, the advanced decline line, and the bottom one is based on volume. What we're looking for here are divergences or convergences. Right now, they're pretty much converging with each other. It's really divergences that we look for. When we make a higher low here, but yet a lower low here, that's a warning sign. Well, we're not really seeing any of that right now. Then we have a thing called technical alerts, and this is put out by stockcharts.com. The last few videos I've been able to show the whole week. Well, we had so many alerts triggered this past week that I can only show the ones that were actually triggered on Friday. And we read this from the bottom up. And this is when something happens. When it's positive, it's blue or green. When it's negative, it's red. And these are just triggered, and you can have them delivered to your desktop. I'm not sure if you have to be a member or not to get access to these. But as we were going up and the market was pretty strong this past week, we saw a lot of positive signals being generated. This not only looks at the S&P, it looks at the NASDAQ, it looks at different sectors, it looks at different markets. And when something significant happens, it pops up here. And near the close, that's where we read at the top. So you start at the bottom and work your way up with this. Then we have 5 main indexes that we follow. The S&P is the benchmark for everything that I do and everything that I teach. We also keep an eye on some other indexes, such as the Dow, the NASDAQ 100, the mid caps and the small caps, in addition to the S&P 500. And then Stock Charts has this ability to rate their current technical score on a scale of 0 to 100. The higher the score, the better looking the chart. Coming in first place again this week are the QQQs, which is the NASDAQ 100. And we have been seeing some weakness here, but it's been coming back up, and we're at 95.8. In second place is the SPYs. This is the ETF for the S&P 500. It's showing some improvement as well at 79.9. In third place are the Diamonds, which is the ETF for the Dow. It's also showing some improvement, coming in at 62.5. Then in fourth place are the mid caps, also showing some improvement after being quite weak. They come in at 44.4. And in last place, but showing some improvement, are the small caps. This is the IWM, which is the ETF for the Russell 2000 small cap index, and it comes in at 35.2. And some short-term charts. I don't have a lot to show because as we've been shifting, just a week ago, everything looked like the world was coming to an end. And then we had this powerful up week, and a lot of the real movement that we're seeing is in the short-term charts. But I do have a few to show you. We were able to get back above the 20-period simple and exponential moving average. And now that we're getting kind of far away from that, I haven't been showing this chart. I did earlier in the week, but later in the week, I stopped showing this because it's like we're just getting further away from that. Now, we're coming up to some resistance here. And if we really top out at this point and become overbought and come back down, then I might start showing this chart in the videos again. Then we have a moving average study based on an exponential way of measuring things. We have a 20 period, a 50 period, and a 200. Usually we use this like an oscillator when we get extreme negative, which we were not so long ago, both for the 20 and the 50. But as the market's been bouncing back up, we're looking a lot more positive. Any more follow through, and this could go extreme positive. We're turning positive with the 50, and we're also turning back up and looking better with the 200. Then another oscillator that we look at, the CCI based on 14 periods, I've been showing that one. That's a lot faster. This is a CCI based on 20 periods, a little bit slower. It is showing a lot of improvement, but not giving us an extreme reading. And then the boom indicator. This is based on a 20, a 50, and 200-day moving average. How far is price away from those various moving averages? When they move really quickly in one direction or the other, they have a tendency to come back to the moving average. And that's what this boom indicator tries to measure. We're getting close to the point where we're almost extreme with the 20 period. We crossed back above 0 with the 50 period, so that's turning things more positive. And we've also turned back up above 0 with the 200. So other than in the short term, we're looking possibly a little extreme. We're seeing the intermediate and long term start to show some real improvement. Then some intermediate term charts. This is an intermediate term rainbow. Usually I show a short-term rainbow, but I use that in the video for Monday's session. This is an intermediate term rainbow going from 50 periods up to 100 periods, and we're coming back into the rainbow now. And so there's really not much that we can get from this other than to look at the cool colors and go, okay, all right, we're going back inside the rainbow now. And then Bollinger Bands. We use this to notice when we're going up or down really quick. On the bottom is the percent B indicator. And this starts to get extreme positive or negative when we close outside of the upper or lower Bollinger Band. Well, we had become close to being extreme negative before we turned around. I also look at the midpoint. When we're above the midpoint, that's more positive. When we're below the midpoint, that's more negative. And we're showing a lot of improvement here. We're crossing back above the midpoint as measured down here and looking more positive, but not getting an extreme reading currently. Then I did show this earlier in the week because as we were falling a week ago, we started to drop below this anchored moving average going back to the all-time high. Well, we were able to recapture that and we've been moving further away from it. So I stopped using this chart. Then we look at the Sean trend meter and it had gone extreme negative, and that's when I was showing it. Well, as we were bouncing back up, we're back into this kind of sickly yellowish area here, which is more neutral when you look at just the color. But when you look at the direction of the line, it does suggest that things are turning more positive. Then the 50-day cycle, and I was showing this all the time when we had our last turn right around October 17th. Well, we started to drop down after that, and now we appear to be reversing. So maybe this is outside of the 50-day cycle. We just use this for observation purposes. It works sometimes, it doesn't work other times. And we want to keep an eye on the S&P 100, which are the biggest stocks in the S&P 500, just looking for any kind of convergences or divergences here, and they're pretty much going in the same general direction. Some long-term charts. This is a long-term rainbow going from 50 periods up to 250 periods. We're also working our way back through the rainbow again as things are looking a little bit better. And then this is a long-term moving average study. And I was showing this as we were going extreme negative with the 150 and 200. We wore off those conditions and we're back to looking a little bit more positive, but we're still below this midpoint, both for the 150 and the 200, but it is showing that things are improving. And then we have a weekly chart of the S&P on top, and then we have a weekly chart of the German DAX in the middle. And we're looking at the correlation between the two, and they have a pretty strong correlated relationship. If they're going up or down, they're tending to do it on a weekly chart in the same direction at the same time. Some support and resistance. I've been using a lot of these because the S&P has been able to capture back a lot of levels that were lost when we fell down through them, and now we're coming back up above them. But there's still a few here. One that kind of goes along with this is a thing called the mass index. And it's kind of interesting. We had more of a full-blown signal back in August that ended up being a false signal. And then we had a false signal here because it didn't get all the way up to the blue line. And then the signal was actually triggered when we dropped down below the red dash line. Well, this would have ended up being kind of a pretty good signal here. That's about the time when we reversed. And that's what the mass index tries to do. Whatever direction we're moving in, when this signal is generated, it looks for a reverse to happen. So that's why we use lots of different charts to analyze things. And the Pring bottom fisher, it was giving us a signal as we were going down, down, down. It was like laughable. It was the exact wrong time to give this signal. This is pretty good at picking when we bottomed out, but it didn't even generate a signal when we bottomed out here in late October. But it's not giving us any kind of a signal now, so I haven't been showing that. And then this is one I did show for a while. This looks at the October 2022 low, and here's the October 2022 low, and then the June 2022 low, and then draws a trend line between them. And then a parallel line going from the all-time high was drawn down this way. And last spring, when we were going up, this did provide some resistance. Well, we broke through that. And so I just would talk about this chart, but I wouldn't show it. Well, as we were screaming down here, I extended this trend line just in case we continued to fall and maybe this area would have acted as support. Well, we've kind of reversed around, so I stopped showing this chart too. Some broad market indications that we look at. We have the Vixen, which is the VIX for the NASDAQ 100. I don't use the bar chart up here because there's a lot of erroneous data here. I mainly look at the line chart on the bottom. And as the NASDAQ 100 has been going up, fear has been really starting to decrease. And then we have a weekly chart of the QQQs, which we're kind of far away from this anchored moving average going back to the all-time high. I never did really show this chart, but we're just seeing a bit of an improvement here as the bigger stocks are leading the way to a degree as we try to bounce back up. Here's the bank ETF, which, yeah, it's looking a little bit better. It got back up to its 200-day moving average on Friday, closed right on it. But we just came crashing down last March when we had the banking crisis, and we've been going sideways ever since. Can this get some legs and continue to go up, or is this just an anomaly and then we're going to turn and start to go back down? We also look at the regional banking ETF and compare it with the financial sector, where it's been really underperforming, but it did spike up a little bit last week. We look at a ratio between the QQQs and the diamonds, and I mainly look at the bottom, and they're having a slight, pretty strong tendency to go in the same general direction. This is the Dow and the NASDAQ 100. It is coming off a little bit as we're seeing them getting a bit out of alignment with each other. And then some rate of change charts. These are very long term. This is based on 250 periods. We look at right now and then go back 250 periods ago, and we're starting to show some improvement here. And then I just have a longer version of this same chart where we're still tending to hold up okay. And then we have some bond charts to look at. This is the 3 to 7 year bond, and then we take a ratio with the S&P. When this is going down, that means bonds are underperforming. That also means that stocks are outperforming. And as we've been coming back up, that means stocks have been doing better than bonds, but this ratio really ended up coming back down in the last week. We also keep an eye on TIPS, which are Treasury inflation protected securities. When the market is really uncertain about inflation and interest rates, they'll get into TIPS. And that's when these tend to outperform the further out bonds based on 3 to 7 years. Well, we've been chopping sideways and actually going down here. And this means, well, maybe inflation isn't that big of a deal when we just look at the 3 to 7 year time frame. But look at the next chart. When we go further out, the market is more concerned. When we take the TIPS to the 7 to 10 year, this means that there's more concern about inflation further down the road right now. So we've been keeping an eye on this. And then we look at the S&P 500, which is in red, and the TLT, which is the ETF for the long-term bond, that's in blue. They have a pretty strong relationship based on 50 periods, and it's getting stronger based on 10 periods. Down below, I just have different ways of measuring the spread between the two. We look at the value to growth ratio, which is the black line, and it's been going up. Value, and this is a concern of the market right now. Value's been outperforming growth, even though we had a really good week this past week. When the market's really strong, we want to see growth outperforming value, and we're not seeing that at this time. And the red line up here is the 10-year treasury yield, where it's really coming down. Now, you can really know how much you get from this chart because you can see the red line's coming down and the black line's going up, but they're having a slight tendency to go in the same direction. Okay, I'm not seeing it here, but that's what this indicator picks up. We use it when it seems to tell us something. Right now, it seems to be telling us the opposite of what's really happening. And then we look at the QQQs to the long-term bond ETF. They are having a pretty strong tendency to go in the same direction. The TLT's been going up as the QQQs have been going up recently. And then we're keeping an eye on the 3-month yield. We don't know if this is going to be a big deal or not. It was back in 2007 when we topped out and started to come down. That was the great financial crisis. Well, we got above that level with this interest rate, and maybe we're starting to roll over now, but we're not really starting to come back down yet. And we're wondering if that happens, is that going to give us a warning sign? Or are we just going to keep going up because we're switching back possibly to an environment of higher interest rates longer term? And then here's the yield curves. I showed a lot of these charts individually. We have the 10 to the 2 and the 10 to the 3 month, which are showing improvement, but they're still inverted, where the 30 to the 5 and the 10 to the 5 have gone back to being normal. And I kind of show them when they seem to mean something, and then I leave them out when it doesn't seem all that relevant. And then I have a thing called possible positive scenarios. And this is usually when we're really screaming down. Maybe we've hit some kind of a mark bottom, and then we'll come up out of that. Well, since we are coming back up after we were really declining, I've been using a lot of those charts in the daily videos, but I still have a few here to show you. The first one is the percent of S&P 500 stocks that are above their 200-day moving average, and it's showing some improvement here. Now, in a much broader sense, we can use this like an oscillator. When we get extreme positive or extreme negative, we haven't had one of those recently, so we just follow the general direction of, is this line going up? That's positive. Is it going down? That's more negative. And then we keep an eye on the 2-year treasury yield and compare it to the S&P 500. The problem we're having right now is they're having a tendency to go in the same direction. That was a week ago. Now we're seeing them going more in the opposite direction. So we'll be keeping an eye on this. If the 2-year yield starts to really come down, often that will give short to intermediate term support to the S&P, because interest rates going down, that could be more friendly for the stock market. Thank you. I really hope you found this helpful. I think you would find it a lot more helpful to watch the daily videos, the weekly videos, and intermarket analysis video. But nonetheless, take what you can from the information that I post. I hope you have a great weekend, and I will talk to you in the next video.